when you see exchanges popping up in Singapore, when you see the rise and the legitimacy of the Shanghai exchange, the BRICS gold market that's being built, the Russian market, the market in Dubai, all of these systems are being built to challenge the West for paper price supremacy. And it won't be paper. It will be the real price, because these exchanges are largely cash and carry and no futures. What is the price? But they're using the stupidity of our suppression against us. They're wise to the game, and they're using it against us until there's no more blood to be drained from the system, and then you'll see that switch happen. That's the all at once moment. It's the little by little, then suddenly the little by little is happening right now in front of us.
Recent data from the US Treasury reveal that key BRICS nations, including China, India, and Brazil, collectively sold $18.5 billion worth of US Treasuries in the past month. China led the way with a massive $16.4 billion reduction, while India offloaded $1.5 billion and Brazil trimmed its holdings by $600 million. This selling trend coincides with a broader movement among BRICS nations to reduce reliance on the US dollar, adding to mounting speculation about a shift in the global financial order. While China and Russia push forward with plans for a potential BRICS currency, India and Brazil remain more cautious. Still, the momentum behind a new tender is growing, with Russian President Vladimir Putin having publicly displayed a mock-up note at last year's summit. As the alliance inches toward launching this currency, the intent is clear: to challenge the dollar's global dominance. AndySchectman, CEO of Miles Franklin, warns that widespread dumping of U.S. Treasuries by foreign powers could have severe consequences. A flood of dollars returning to the U.S. could trigger hyperinflation, send interest rates soaring, and ultimately collapse the dollar's value. In such a crisis, gold could re-emerge as the foundation of a new monetary system, a shift that may already be underway. The U.S. dollar's share of global foreign exchange reserves has steadily declined from over 70% in 2000 to 57.8% in 2024. Much of this shift is being driven by Asia, with ASEAN actively promoting the use of local currencies in trade under its strategic roadmap for 2026 to 2027-30. In tandem, the U.S. has quietly ramped up gold imports, adding over 600 tons from London and Switzerland in just the first 2 months of 2025, according to the World Gold Council. Schectman adds that as nations compete to accumulate gold, the pressure on prices will only intensify. The BRICS bloc is also laying the groundwork for trade settlements backed by gold rather than the US dollar, establishing regional exchanges in Saudi Arabia, Africa, and South America. These moves signal a gradual but meaningful shift in financial power, one that could reshape the global monetary landscape in the years ahead. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think because they're playing the long game. You know, everyone's, well, why not just buy it all up? They're playing the long game. They're siphoning as much as they possibly can from the system before we see anything that happens with gold. And you're right, it would benefit the BRICS nations. It might also benefit the United States with the amount of gold that's been coming into the country.
Well, when we were talking about with the BRICS and them actually not having it be backed but pegged, isn't that a big the big difference between that too? That they wouldn't say that they're not going to say, okay, now it's $30,000, but it's the U.S. It's the price in U.S. dollars that would equate to the BRICS currency. So that way they don't have to actually put up the money for the gold, but it's as our inflation goes higher, which they know it's going to, the price is going to move in the direction that they want it to. Therefore, it's going to increase their currency. It's a brilliant methodology.
If they try to compete with the BRICS nations, which it looks like they are, to accumulate gold, the price goes higher.
Right.
And if they devalue the dollar, which Trump wants, the price goes higher. But the BRICS nations aren't really thinking about, at this point, building a settlement currency or a common currency. It is a settlement currency rather, instead of a common currency. They're using gold to settle imbalances. And you can see that by the Shanghai Metals Exchange wanting to put extensions of the exchange in Saudi Arabia, in Hong Kong, and then in Africa and South America for settling trades over their M-Bridge, over their bridge platform, their bridge network. And that is where you will see gold really start to perhaps be revalued or to move much, much higher, when the realization that it is being used as a de facto settlement vehicle and also a preferred vehicle for in lieu of US Treasuries. So we're not there yet, but I think it's getting closer every day. You can kind of feel it. In January 2000, Well, let's start today. Today, the average price of a home is $416,900. And so at $3,400, I did this the other day. So let's just call it $3,400. You need 121 ounces of gold to buy a house today for $416,000. Median price. Those 121 ounces in January of 2000 with gold at 274 would have been 33,300. So when you think about the way that gold has appreciated, earning no interest, it was worth 33,000 25 years ago, and now it's worth 416,000, and it buys you a house. And so the message I would say is that silver hasn't accentuated itself because it's been held down. My advice would be to buy silver, and in a few, buy a few thousand ounces, and in a few years, it might buy you, in 10 years or 20 years, might buy you a nice home. But you let the laws of compounding work for you instead of against you. Anything besides saving in fiat, because this explains if you would have saved that money in fiat instead, and you put that 33,000 in a jar, well, okay, it's still a lot of money, but what does it buy you? The equivalent amount in gold in a jar, both earning nothing but dust. One is worth now 416,000 and one is worth 33,000, but the purchasing power since 2000 has evaporated of that 33,000. So these are the kinds of lessons.
I lost 30% at least.
Or more. It's lost 10% this year alone.
Right.
It's a big deal. The commercial banks have the second largest short position in history of the COMEX market ever. Why would they be doing this? And to me, it represents an existential threat to them. And one of these days, the challenging by the BRICS nations in particular, China, who are gobbling, one of the guys, Eric Young, King Kong on Twitter says, look, China's playing the long game. Hold on to your silver. They're buying up everything they can across the globe. They're doing it for a reason. They see the future, one that is becoming harder and harder and harder to source silver at that level. Why do we see the largest delivery in the history of the COMEX in the May contract? So it's getting to the point where things are accelerating. And yeah, it has been frustrating. It has been counterintuitive. There is no question about it. And this is what I said to everyone who came into the market in 2021 during I was just on with Ivan today, right before you got here on Wall Street Silver. I said, look, people who bought it back then bought it for the wrong reason. They bought it to get rich. That is not why you own it. Now, asymmetrically, low downside, high upside, I think people who own enough of it will become wealthy. But that's not why I've ever sold it to anyone. And I think it's wealth. And a system like I showed, just looking at the performance of the dollar since 2000 and its relative value holding up in gold and silver, it's been abysmal. Silver should be higher, no question about it, but it will have its day. I think that natural reset could be a situation where the world, like Operation Sandman says, we've had enough of the United States, of their monetary irresponsibility, their fiscal irresponsibility, their rules, their sanctions, their warmongering, etc. I'm not saying this is my belief, but much of the world does believe this. And I think if there was a coordinated drop of treasuries and dollars at some point that really began to accelerate, think about what that would mean. All of those dollars would hit our shores, creating hyperinflation. Rates would spike, and in order to compensate for that inflation. And in that environment, stocks, bonds, real estate, the banks, the insurance companies, they all implode. And now you reset the system. That's how that would happen. And it would be tied to gold, I believe, this new system. I really do. It will be backing a new system, whether it be through the treasuries, like Judy Shelton says, or something more ambitious like the BRICS are doing. I do believe that gold has a role and is quietly being reintegrated into the system, which you could argue is in the process of the first reset. So the second reset would be a scary thing. It would be a collapse of the dollar, a collapse of the system, and a spiking of interest rates to levels that would reset everything. And then in comes gold. So how does that play out? Don't know. Let's hope we don't find out.
Exactly.
Remember,
you have to have
silver is used in high-tech weaponry, and BlackRock is the primary custodian with JP Morgan of SLV, and they're deeply involved in other gold and silver ETFs, including GLD. They need it to make weapons. And that's why they've held the price down, to make high-tech weapons so that they aren't crowded out of the silver space in order to build the weapons, in order to blow up countries like the Ukraine and then come in and get the reconstruction projects. BlackRock does. It is a military industrial complex suppression scheme that is coming to an end because the rest of the world is wise to it. They were never coordinated or motivated or sophisticated or wealthy enough to stand up to the United States. They are now in unison, in coordination. And you just got Singapore that just over the weekend they're opening up an exchange. You're seeing all of the demand move eastward and to challenge the West in pricing. Not just, the supremacy of the West, the Western rules-based system has benefited the West. And not only have they used the military to keep that in check, but it's benefited us in commodity pricing, in printing of currency, and all of these things. It's slowly moving eastward. And when you see exchanges popping up in Singapore, when you see the rise and the legitimacy of the Shanghai exchange, the BRICS gold market that's being built, the Russian market, the market in Dubai, all of these systems are being built to challenge the West for paper price supremacy. And it won't be paper. It will be the real price because these exchanges are largely cash and carry and no futures. What is the price? But they're using the stupidity of our suppression against us. They're wise to the game and they're using it against us until there's no more blood to be drained from the system, and then you'll see that switch happen. That's the all at once moment. It's the little by little, then suddenly the little by little is happening right now in front of us.
Gold slipped more than 1% on Monday as traders locked in profits following an extended rally that pushed the metal to an 8-week high. The decline comes as market attention turns to escalating tensions between Israel and Iran, along with the highly anticipated Federal Reserve policy meeting this week. Analysts note that the recent rise in gold prices was primarily driven by geopolitical concerns, making the current dip a natural correction after such a sharp move. Gold has already delivered a strong performance this year, gaining as much as 30% year-to-date when it peaked at $3,500 per ounce in April, well beyond JP Morgan Research's earlier projections. Despite some voices in the market expressing frustration at gold's pace, AndySchectman points out that it has already risen over 40% last year and 30% so far this year. He emphasizes that gold's reaction to crises is often misunderstood. Historically, it tends to dip initially while stocks rise, before reversing course and outperforming over the long term. Looking ahead, JP Morgan Research has revised its forecasts upward, now expecting gold to average $3,675 per ounce by the fourth quarter of 2025 and approach the $4,000 mark by the second quarter of 2026. With central bank demand strong, geopolitical risks rising, and monetary policy remaining uncertain, gold continues to hold firm as a strategic asset in uncertain times. Let's get back to the interview.
When you see $4.5 billion delivered by JP Morgan on the March contract for a client, it was Blythe Masters, who used to run their gold desk, said, "We don't buy it. It's always for clients." Right. Who's got $4.5 billion? And then we saw, over $8 billion delivered in the May contract. Who has the? Yes, I do think that the U.S. government, and I think someone got to Trump in this current administration, Bessent or whoever it is, Judy Shelton, someone, and said, if you don't do this, you are creating a very, very, very big problem for the United States going forward. The world is draining the exchanges. And so since November, we have been net importers of gold, huge deliveries month over month over month over month. And I've wondered a lot out loud, silently and out loud, is it the U.S. government? Is it the Treasury? I believe it very well could be. Well, it simply means that in order for the banks to be able to count it on their balance sheet as, in essence, a high-quality liquid asset, it has to be held unencumbered, not in futures contracts, in the vault. And so what that does is it greatly reduces the incentive to have large positions that are unallocated, that are paper positions. It should be very bullish for the price ultimately. And although there is some people are saying, well, why isn't it exactly tier one on par with the U.S. bond market, which all of us were led to believe to some degree. In essence, it is. The banks view it that way. But if they were to put it on par, to say it is exactly a high quality liquid asset, the same as a treasury, it would, many believe, would greatly undermine the treasury market like it already is with many of the central banks. So the central banks are behaving, especially with the massive deliveries that we're seeing off the LBMA and the COMEX. They're behaving like it is tier one, and they are rushing, scrambling to get it in their possession. And so I don't know. I think we could expect to see higher prices, more deliveries, and a shortage at the upper levels. That's the issue. It's interesting. If you want to talk about an interesting dichotomy right now you have over the last 4 weeks, you've had roughly $2 billion per week in institutional selling in the stock market. $4 billion the first week of June. These are massive, massive amounts of selling. You have Buffett sitting with $500 billion in cash, almost $500 billion. You have all the insiders out and the institutionals selling. At the same time, over the same period, you have a record participation with the retail mom and pop investors are more all in stocks than ever before. At 53% of all the stocks are owned by the retail, by the people. It's a very ominous sign. So on one end, you have the public all in on stocks. On the other end, you have the institutionals selling at a level we've never seen. Now contrast that with metals. On physical side, you have people asleep. That's why you have such low premiums. They haven't been buying. They've been into the risk on trade in NVIDIA and all these other stocks that are attracting them to the point of being the most heavily invested ever. And at the same time, you have the biggest money in the world. The central banks, the hedge funds, or the family offices, the sovereign wealth funds, they're all gobbling up and standing for delivery all of the gold and silver that is available. So it's interesting. At the very top, the smart money is buying commodities and selling equities. And it's the polar opposite when you talk about the retail, the street. Who's going to win that one, do you think? What could possibly go wrong? And so I would simply say that that we should expect to see not only these Basel III changes increase the demand for physical ownership of gold at that high level, and we're seeing that with all the deliveries, but I also think it's an ominous sign that you have the institutional selling equities and buying physical, and the opposite is true for the public. It to me is a contrarian indicator that we should watch and talk about over the coming weeks. This is how the BRICS use. Most people think this way, and it's normal. Why is it falling? Yet it's outperformed virtually everything. It's up 40+% last year. It's up 30+% this year. And what I will tell you, as someone who's been doing this a long time, in every major conflict that I've ever seen, starting with Desert Storm, we expect the price of gold to go up. We expect the stock market to go down. And within a day or so of the skirmish or of a war happening, it's the opposite. And I think that's also being done by design to keep people from flocking out of currency into gold and silver, to make the markets appear stronger than they are. Look, as Chris Powell of GATA says, there are no free markets, just manipulations. And this is done by design to kind of keep everyone calm. If gold were flying off the handle and the market was collapsing and the 10-year Treasury was going to the moon like most people think it should.
The accelerating retreat from U.S. Treasury holdings by major emerging economies signals a deeper recalibration of global financial allegiances. As alliances explore alternative settlement systems and regional exchanges gain traction, gold is once again stepping into the spotlight, not just as a hedge, but as a contender for monetary reinvention. At the same time, short-term fluctuations reflect shifting sentiment and profit-taking. The broader narrative, however, points toward a systemic realignment. With growing uncertainty around fiat stability and mounting interest in gold-backed frameworks, the future of cross-border trade and reserve strategy may soon look very different from the past. Could we be witnessing the early stages of a paradigm shift, one in which physical assets reclaim center stage in the global monetary architecture? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.